I think it's just this universal fantasy, right? For anyone who has ever stared at a blinking trading chart.
Oh, absolutely. Just watching those candles go up and down.
Yeah, and you're sitting there getting cold sweats, trying to decide whether to buy or sell. We've all had that exact same thought.
The thought of just, handing it all over.
Exactly. What if I could just hand the steering wheel over to an AI? Just completely remove my own sweaty palms and, well, all my human emotions from the equation.
Right. Let a machine make the money while you sleep. I mean, it's the ultimate trader's dream.
It really is.
Because human psychology is undeniably a trader's worst enemy. You panic when a trade dips, or, you get greedy when it climbs.
Ooh, or revenge trading.
Yes, you revenge trade after a big loss to try and make it back.
Yep.
So taking the human out of the loop just seems like the obvious solution.
But then you look at a real-world attempt to actually build that system, and that's what we're doing today.
We've got some amazing sources for this deep dive.
We really do. We are cracking open the personal developer logs, the raw performance metrics, and the candid private notes of a trader who decided to run a live experiment.
And they aren't just running like one basic automated MetaTrader 5 bot, right?
No. They are running 3 completely different algorithmic trading bots side by side on their home computer. They want to see which brain actually survives the market.
And reading through these notes, you quickly realize this isn't just some coding challenge.
Right, it's deeper than that.
It really is a fundamental choice about how much control you are willing to surrender to a machine.
I totally agree. The central tension in these developer logs is just fascinating. We are specifically looking at a snapshot of their performance up to May 14th, 2026.
That's our target date for this comparison.
Yeah, and the developer built 3 distinct design philosophies into these bots. So today, our mission is to unpack those philosophies, look at the May 14th data, and figure out what this means for the frontier of AI in finance.
Because this goes way beyond seeing which bot made the most Japanese yen.
For sure. It's like a robot wars experiment.
Right, but the stakes are so much higher. It is a profound test of artificial autonomy. If you give an AI the power to lose your actual money, how tight of a leash do you need to keep it on?
I see this whole experiment like a corporate office. You have 3 totally different types of employees managing your money.
I like that analogy.
So you have the first bot, Bounce Sniper. This one is the blindly loyal foot soldier. You tell it to march, it marches.
No questions asked.
Exactly.
Yeah.
Then you have the LLMBridgeTrader. This one is, well, it's the highly creative, maybe slightly unpredictable autonomous manager. It comes up with its own strategies.
Which can be a bit scary.
Very scary. And finally, you have GateGrid AI. This one acts like an overly conscious legal committee whose entire job is to find a reason to say no to everything.
Those employee archetypes map perfectly onto the technical structures here. The developer's goal is to observe these 3 mentalities in the wild, and figure out the ideal ratio.
Right, like what's the perfect mix?
Exactly. How much rigid rule following, how much creative AI discretion, and how much aggressive risk management does it actually take to survive?
So let's put the loyal foot soldier under the microscope first. Bounce Sniper bot.
The soldier.
Right. It targets the US dollar to Japanese yen pair on a fast 5-minute chart. The design philosophy here is purely rule-based.
Purely. There is zero artificial intelligence involved in its brain.
Nothing. It has no awareness of the news, the global economy, or even what the chart really looks like, honestly. It is just an execution machine.
Well, the logic actually lives completely outside of the bot itself.
Oh, right, on TradingView.
Exactly.
Yeah.
The developer set up a strategy on a web-based charting platform called TradingView. So when that external strategy generates a buy or sell signal, it fires off a webhook.
Which is essentially just an automated text message from one app to another.
Basically, yes.
But I noticed in the logs they had to set up this thing called a Cloudflare tunnel just to get that message. Why go through all that trouble?
Well, think about it. TradingView is on the public internet, right? And your trading bot is running on a private computer in your house. TradingView can't just knock on your home network's door and let itself in.
Oh, that makes sense. It's blocked by the router.
Exactly. So a Cloudflare tunnel creates a secure private pipeline directly to a local server on the developer's PC.
Okay, I see.
So the signal travels securely down the tunnel, hits the local server, and the Bounce Sniper bot immediately executes the long, short, or exit command in the trading software. It simply eliminates the human data entry.
So we look at the snapshot for May 14th. How did the soldier perform with this setup?
Well, it lost 276 yen.
Right. But you look a little closer at the data, and it actually won the majority of its trades that day.
It did. It had a 57.1% win rate. That's 4 wins and 3 losses.
So if it won more often, why did it lose money? The developer's logs highlight a critical vulnerability in rule-based systems here, right?
Yeah, the bot didn't fail mechanically. That's the important part. There are system logs showing it successfully navigating complex broker-specific errors.
Like that unsupported filling mode error.
Yes, exactly. Which means it was intelligently adapting to the broker's technical demands. It did exactly what it was instructed to do.
But it still lost money.
Because the rules themselves failed.
Wow. So if the rules failed, why did it win 4 times?
Because the wins were tiny and the losses were catastrophic. It scored one nice win of plus 444 yen.
Okay, that's not bad.
But then it swallowed devastating losses of negative 534 and negative 406 yen. The rigid rules were just incredibly brittle.
I found the May 12th entry even more revealing on this point. Bound Sniper was running a strategy designed for a range-bound market.
Right, so imagine a market just lazily bouncing up and down between a ceiling and a floor.
Right, like playing ping pong in a narrow hallway. Bound Sniper's great at that.
Exactly.
But on May 12th, the market broke out into a massive directional trend. It just smashed right through the ceiling.
And the bot had no mechanism to recognize that the environment had shifted. It kept trying to play ping pong.
While the hallway is literally collapsing.
Pretty much. And worse, its programmed logic told it to bump its lot size up to 0.02 during that breakout.
Wait, it increased its bet?
Yes. It essentially doubled down on a losing hand because the rigid rules dictated it. It got burned twice for negative 400 yen each time.
Wow. So it followed the rules all the way off a cliff.
Literally.
So if following a strict external rulebook makes your system that vulnerable to market shifts, the natural pivot is to give the bot a brain.
That's the logical next step.
Why not let the bot look at the chart and decide for itself if the market is trending or ranging? And that brings us to contender number 2.
The LLMBridgeTrader.
Yes, operating on the euro to US dollar pair on a 15-minute chart. This is the leap to full AI autonomy.
And the complexity jump here is just massive. LLMBridgeTrader doesn't receive simple buy or sell signals like the first bot.
What does it get?
The system feeds the raw 15-minute chart data and technical indicators directly into a large language model. The AI then has to generate a comprehensive trading plan, which it formats in JSON.
Okay, so for anyone not writing code all day, JSON is basically a very strict, standardized fill-in-the-blank form that computers use to talk to each other.
That's a perfect way to describe it.
So the AI has to fill out the form perfectly, deciding whether to open, hold, close, or reverse a position. It even dictates the take profit and stop loss levels in pips.
Pips being percentage in point, the smallest measurable price movement in the foreign exchange market.
Right. It's the equivalent of agonizing over fractions of a penny.
Exactly. And the AI also has to generate its own confidence score from 0 to 100 and classify the market condition.
It actually writes a little note, right?
And yeah, it writes a note saying, I am entering this trade because it is a trend-following setup.
That's wild. But giving a bot that much autonomy requires some heavy lifting, and the developer's hardware really struggled here.
It did.
If you are building this, you might wonder why you wouldn't just plug your bot into ChatGPT over the internet and let OpenAI's supercomputers do the thinking.
Right. The developer explicitly addresses this. Running a highly active trading bot against an external API introduces unpredictable variables.
Like what?
Well, first, you rack up massive costs for every single query. Then you hit rate limits where the server just cuts you off for asking too many questions too fast.
Oh, that would be terrible in a live trade.
Exactly. And there's latency, the delay between sending the data and getting the decision back. In fast markets, a 2-second delay is an absolute eternity.
That makes total sense, plus the privacy issue, right?
Yes. Fundamentally, you are constantly beaming your proprietary trading strategy and live positions out to a third-party corporate server. You just wouldn't want that.
So you run the AI locally on your own machine.
Right.
And the logs say the developer is using an RTX 5070 graphics card, which comes with 12 gigabytes of video RAM, or VRAM.
And that 12 GB is a physical hard boundary.
Right, you can't just download more RAM.
If the brain you download is bigger than 12 GB, it spills out of the graphics card and forces your computer's regular, much slower CPU to process the thoughts.
Oh, so it bottlenecks.
Completely. Your hyperfast trading bot suddenly starts thinking at the speed of a dial-up modem, entirely missing the trading window.
So finding the right brain to fit that 12 gigabyte box was a bit of a journey for them.
It really was. They initially used a model called Qwen 3.59b. The 9D stands for 9 billion parameters, occupying about 6.6 gigabytes.
So it fit the physical space nicely.
It did, but it possessed a psychological flaw that was fatal for trading.
What wasn't
It
it?
couldn't handle ambiguity.
I love the developer's notes on this part. Imagine a scenario where the technical indicators contradict each other, right?
Which happens all the time in trading.
Exactly. One indicator, like the MACD, which generally shows the momentum and direction of a trend, says the market is going down. But the current price action shows the market is clearly going up.
Right. So QUIM 3.59b would panic.
Panic.
Yeah. Instead of stepping back and saying, this data is conflicting, I will sit this one out, it would hallucinate a reason to force a BY or sell order anyway.
It acts like a highly creative chef who refuses to stop cooking.
That is exactly it. If you hand them fish, chocolate, and garlic, a good chef says, I cannot make a dish out of this.
Right.
But Quen would just throw it all in a blender, serve it to you, and confidently call it a masterpiece.
And in financial markets, that improvisation just destroys capital.
Absolutely.
So the developer tried to upgrade to a faster, newer version of Quen, specifically the NVFP4 version, but hit a software wall. It was configured for Mac-only environments.
Which is so frustrating.
Right. So they were forced to perform a complete brain transplant. They gutted Quen out of the bot and replaced it with a model from Google called Gemma 3 12B.
Now, Gemma 3 is a 12 billion parameter model taking up 8.1 gigabytes.
So it's pushing that 12 GB limit.
It fills up most of that VRAM limit, yes, but it fundamentally changes the bot's personality. Gemma 3's core strength is its rigid adherence to instructions.
It's the ultimate by-the-book sous chef.
Exactly. It does not improvise.
The logs show that immediately after the swap, Gemma 3 booted up, analyzed a contradictory market setup, and simply filled out the JSON form with the word none.
It chose not to trade.
It literally analyzed the data and talked itself out of taking a bad risk.
Yeah.
That's amazing.
It is.
So how did that cautious autonomy pay off on May 14th?
Well, it delivered a steady, if unspectacular, success. LLMBridgeTrader secured a profit of plus 113 yen, or plus 110 if we factor in unrealized floating losses.
Okay, steady.
Yeah, it maintained a 60% win rate, registering 3 wins and 2 losses.
So it's not a windfall that's going to buy you a yacht, but it survived.
It survived.
And the sources reveal that the true genius of LLMBridgeTrader isn't just the Gemma 3 brain, is it?
No, it's the Lush, the developer attached to it. They built a system of intense guardrails around the AI.
The surrounding architecture inherently distrusts the AI's output, right?
Very much so. Even though Gemma 3 has the autonomy to design a trade, the system runs a sanity check on the JSON form before executing it.
What kind of checks?
Well, if the AI proposes a stop loss that is mathematically absurd, the system blocks the trade. If the calculated risk-to-reward ratio is poor, the system blocks it.
Oh, wow.
And if the AI's own self-reported confidence score falls below a set threshold, the system blocks it.
You give the AI the freedom to think,
Yeah.
but you violently restrict its ability to act,
That's a great way to put it.
which sets us up for the final contender. Because if LLMBridgeTrader is a system built to let an AI find a good reason to trade, GateGrid AI is a system engineered from the ground up to find a reason not to trade.
Yes.
Tell me about this cautious hybrid.
GateGrid AI targets the British pound to US dollar pair, and it utilizes a grid trading strategy.
Which is pretty controversial, right?
Very. Grid bots are infamous in the algorithmic trading community. Instead of looking for one perfect entry point, they cast a wide net.
Like a literal grid.
Right. They place a ladder of buy orders below the current price and a ladder of sell orders above it. So in a quiet ranging market, the price just bounces up and down through this web, constantly triggering tiny profitable trades.
They just passively scoop up pennies all day long.
Exactly.
But the dark side of a grid bot rears its head when the market trends aggressively in one direction.
The dreaded trend.
Right. If the price of the pound just keeps dropping and dropping, your grid bot blindly buys every single dip. It just accumulates a massive toxic position until your entire account is margin called and blown to zero.
It is the literal definition of picking up pennies in front of a steamroller.
So to prevent the steamroller from flattening the account, the developer racked the grid strategy in this multi-layered AI defense system.
They essentially hired 2 distinct, incredibly strict bouncers to stand outside the club. You have to convince both of them before a single trade is placed on the grid.
Okay, let's talk about these bouncers. The first bouncer is bouncer number 1, the quantitative guy.
Right. This bouncer is a machine learning model called CatBoost.
CatBoost, okay.
CatBoost doesn't read the news or care about the macroeconomic environment. It is purely a mathematical sorting algorithm. It takes the current raw market data and categorizes the probability of success based on historical patterns.
And it adjusts for the time of day, right?
Yeah. Yes. The developer even programmed it to use different mathematical thresholds depending on the time of day, whether it's the Tokyo, London, or New York trading session.
Wow, it's granular.
And if the math doesn't clear the hurdle, Bouncer 1 throws an AI skip error, and the trade is killed instantly.
So Bouncer 1 runs your background check and makes sure your ID is valid. If you clear Bouncer 1, you walk up to Bouncer 2.
Bouncer 2 is qualitative.
Right. It uses a local AI platform called Ollama to run a large language model that analyzes context,
Bouncer 2 looks at the atmospheric conditions.
like the weather.
Exactly. It evaluates the current broker spreads, the average true range, which is an indicator that measures how violently the market is moving, and it even analyzes the bot's own recent win or loss streaks.
And if Bouncer 2 senses that the market is too chaotic or too unpredictable, it issues an Ollama hold command.
It will even enforce a strict curfew. It completely shuts the trading system down outside of authorized hours, like after 3:00 a.m. Japan Standard Time.
It is an artificial intelligence whose sole purpose in life is paranoia.
Pure paranoia.
And looking at the May 14th snapshot, that paranoia was incredibly lucrative. GateGrid AI was the undeniable MVP of the day.
Oh, absolutely. It pulled in plus 928 yen.
That's a big jump from the others.
It fired off 27 trades and achieved a staggering 88.9% win rate. 24 wins, only 3 losses.
And the losses were controlled.
Yes, its maximum localized loss for the day was aggressively capped at just negative 398 yen.
So the May 14th data provides an incredibly compelling argument for this hybrid approach.
The multi-gate system operated flawlessly. The bot scooped up the easy grid profits while the bouncers successfully identified and locked out the catastrophic account-draining moves.
If you are a listener looking at that May 14th data, you're probably thinking an 88.9% win rate. That is the holy grail. Why isn't the developer just turning GateGrid AI's leverage up to maximum, selling the other 2 bots, and retiring to a private island?
Because in algorithmic trading, a single-day snapshot is a dangerously incomplete story.
The developer logs don't stop on May 14th.
Thank goodness they don't. The true value of these sources is the reality check they provide on the very next day.
May 15th.
Yes. The data from May 15th exposes the ultimate trap of worshipping win rates.
Let's cement the May 14th verdict first, just to be clear. GateGrid was the undisputed star with plus 928 yen.
Yep.
LLMBridge was the steady, cautious survivor with plus 113 yen. And Bound Sniper proved that blindly following rigid rules is a losing game, dropping negative 276 yen.
So that's the baseline.
Then the sun comes up on May 15th, the market opens, and the entire landscape flips upside down.
GateGrid AI, our untouchable MVP, goes to work. It executes 39 trades throughout the day. It wins 27 of them and loses 12.
Mathematically, that is a 69.2% win rate.
Which is still great. In almost any context, being right nearly 70% of the time sounds like a masterclass in trading.
Yet its overall financial result for May 15th was a net loss of negative 610 yen.
It won 70% of its battles and still lost the war.
How does a bot with 2 layers of AI bouncers lose that much money?
It comes down to the speed of the market and the asymmetry of the risk.
What do you mean?
Well, GateGrid was successfully scooping up its tiny incremental profits. But then the market moved so violently and suddenly that the bouncers couldn't update their probabilities fast enough.
The steamroller arrived.
This steamroller arrived. GateGrid got hit with a negative 254 yen loss, followed closely by a negative 317 yen loss, and finally absorbed a massive structural negative 715 yen hit.
Oh, wow.
Those 3 specific bad trades instantly vaporized the gains from the 27 successful ones.
When you look at the macro picture of this experiment, a fascinating truth emerges. On any given day, Bound Sniper can run a 57% win rate and lose money. GateGrid can run a 69% win rate and lose money.
The logs scream that in automated trading, the win rate is nothing but a vanity metric.
It's just a psychological comfort blanket, right?
Mm-hmm.
It makes the developer feel smart, but it has almost no bearing on actual profitability.
The sources prove that the true measure of a bot's strength is never how frequently it wins.
What is it then?
The ultimate metric is how efficiently it contains its losses. A successful trading system is defined by its ability to lose gracefully. On May 15th, when the market turned chaotic, the only bot that survived the day in the green was the LLMBridgeTrader.
Wait, really? The Gemma 3 bot?
Yes. It absorbed losses too, but because of its dynamic Gemma 3 brain and those strict, uncompromising guardrails, it kept the bleeding contained and managed to end the day up plus 198 yen.
That's incredible. So the developer's final note suggests that the future of algorithmic trading isn't about picking the winner of this three-way fight.
No, the Holy Grail is synthesizing them into a single entity.
You need the lightning-fast execution infrastructure of the bound sniper.
Plus the deep contextual situational awareness of the LLMBridgeTrader to read the shifting market regimes.
And you absolutely require the paranoid, multi-layered entry gates of the GateGrid AI to prevent you from stepping in front of the steamroller.
Exactly. You combine quantitative mathematical probabilities with qualitative AI-driven reasoning.
You build the strict bouncers at the front door to keep the chaos out, but you also station an intelligent, adaptable manager inside the club to make the nuanced decisions when the environment shifts.
It's the ultimate hybrid.
Stepping back from the VRAM limits and the Forex charts for a second, diving into the sheer amount of computational horsepower it takes to stop an artificial intelligence from doing something stupid really reframes how you look at your own decision-making.
It really does.
The GateGrid system requires an intricate mathematical sorting algorithm, a massive language model analyzing context, and strict time-based curfews just to successfully talk itself out of taking a bad risk.
The energy expenditure just to execute the word no is staggering.
It makes you wonder, if a highly advanced artificial intelligence requires 3 separate, dedicated layers of logic just to stop itself from making a catastrophic error, how many terrible decisions do you and I make every single day simply because we don't have a second bouncer in our own brains to step in and tell us to hold off?
That's a great question.
Maybe we all need to apply a little GateGrid philosophy to our own lives before we make our next move.